Thank you. Let's get to it. Got a lot to cover. As always, if you guys have questions, please do ask. Welcome to do that. Happy to answer. And you could always get me, as it says, at mastertrader.com, Greg at Mastertrader. Always answer questions. All right, so a little bit about myself. If you're not familiar with who I am, I've been around for a very long time. I started out back in the late 1980s, and probably most of you that are here, I knew less than any of you because I knew probably next to nothing, other than I knew there was a stock market and I wanted to figure out how to make money. So through a process of trial and error, trying to figure it out, there was no internet. There weren't great webinars like this where you get to hear a lot of different ideas. It was newspapers, snail mail. Just was no internet, so it was much more difficult to learn. So, over some time, I created a fax letter in 1994. Started trading full time, and fax letter. You can pay. Things were expensive back then, to trade. Not so much the software, but you had to pay. Data feeds were expensive, and so it was a way of, how do I pay for some of this stuff while, thinking about bringing in some money while trading, which is not quite as, I shouldn't say reliable, it's just not as steady. You're not just getting a paycheck per se on a week-to-week basis or month-to-month. So it was a way of creating some income. And so fax letters, thermal papers back then, 800 phone line, first chat room ever. You couldn't talk. It was just typing. It was really the, archaic days of starting out trading, had offices, did seminars in hotels. Master Trader was a brokerage firm. Right? That came, I think, in 2000. I forget exactly. It's been a long time. But mastertrader.com used to be a brokerage firm, one of the first brokerage firms ever for retail traders. And so had a lot of old recordings that I created in the 90s and sold them off to another company that wanted them. And here you go, take them, recreate new stuff, based on the current market environments. And so I did that. Did lots of trading challenges, at the time, and taught lots of people. You could see those books there on Amazon. You can pick them up. Good books, great information. As I said, taught hedge fund managers and market makers and specialists. And so at the time, I thought, wow, these people were coming to me for education. And I thought to myself, how lucky am I, to pick the brains of some of these people. And what a disappointment that was. I mean, these people knew nothing. I mean, as far as charting goes, and they just had access to order flow, and that's how they traded. But they wanted to learn how to read a chart, and that's why they were there. And so, as I said, I've taught prop traders and many, many people over the years. And some of my students have become educators. And you may go to a webinar and hear somebody using some of the same terminology as I do because they learned from me during those late 90s and 2000s and so. And so I've listed them, pleasure to list them on my website as companies that are past students, and you can check them out. This is me in the middle there, 1999, the first Trader Expo. There's a big giant booth back there. Training, trading, and technology was the origin of the concept of T3. And the old company was the Pristine Day Trader. That was the logo you can see up above my head there. And the fax service that would come out. And eventually, it was just, the evolution of the internet and created a website and all those things that happened. It was a wonderful time back then as everything evolved from, just the nothingness of trading and being there in the infancy stage and seeing it come up at that time. So how do we approach the markets? And the approach to the markets is to put together pieces, so to speak, of a foundational method And so, like building a house, you take different pieces and you put them together and you build a foundation and you build a home and a sound structure. And so this is it. The different pieces that we put together as a method. So it starts out with saying price is king. This is what we trade. This is what's on the charts. It comes from an exchange and it's displayed on your chart in a candlestick format. You can put it in a bar chart. Why do we use a candlestick format? It just creates pictures that are easy to see and determine high, low, and close, and open and close, and what that bar meant in the moment. From there, bar by bar analysis. This is a great concept that I coined bar by bar analysis, and it's to take every individual bar. What does that bar mean? Put it in the context of the trend, multiple time frames, support and resistance, relative strength and weakness. I'm going to show you how I use moving averages. I'm going to apply this to the broader markets and its trend. And then into market analysis and market internals. This measures what's going on under the hood, so to speak. Right? This measures breadth, measures sentiment. This measures money flow. And how is money flowing from one market to another? We saw crude oil spike up in a big way, come back down, how that affects the markets. How does interest rates affect different markets like home construction and home builders? And we put this all together. And in of itself, none of those are a trading strategy. So we have to put these together to form strategies. And as we do that, then it comes down to position and money management, which is really, it's at the bottom of the list, but it really should be at the top of the list. Because without position and money management and just a minor understanding of that, a basic understanding of that, you'll never make it. You can know every candlestick name by the book, which won't make you money. But if you learn basic money management, which you might think, well, who wouldn't want to learn basic money management if I'm risking my money in the markets every day? You would be surprised. Having done this for decades, that is the course that people least want to learn about. Seems amazing. Maybe they just think they're all so smart, they don't need it. But you know what? The statistics show that the majority aren't that smart, and they do need it. And if you apply even the basics that I'm going to show you, which I go into much greater depth in the courses, you have the chance of making it in this industry. Without that money management and the discipline to follow it, you will not make it. I guarantee it. Trader psychology is directly related to money management, and it's directly related to this price data. And I'm going to explain why right now. Because as it says right at the top of there, technical analysis. It's not about dark cloud covers and piercing patterns and morning stars. It's about pictures of what other people believe. And what are their expectations? And it's created with money. As they place trades and they press that button, it's displayed there for all of us. And I'm not talking about time and sales and level 2. I don't even look at that because it's a detriment, I believe, a detriment to the trading. I'm not a hyper scalper where I'm looking at that, looking at how many green prints or red prints, not at all. I'm looking at these pictures, right, in the candlestick format that tell me what's going on a continuous basis. So as players place those trades, it tells me how they acted. What are their beliefs? Each candle tells me something about traders' beliefs. Now, one candle, while it tells me something, it doesn't tell me the big picture. So I have to put it in the context of that big picture and doing on an ongoing basis. And so the point is, it tells me candle language. What are continuous thoughts and decisions? And the price structure will tell us where traders will act. Absolutely. I know for a fact where traders are going to think about buying and where they're going to think about selling. You might think that's a bold statement, but I'm doing this for decades. I've shared this with thousands of people that use it. And it's just simply, and I've said this thousands of times, for those of you that are in this room, heard me speak before, I say just look to the left. You don't need anything proprietary. You don't need trend lines. You don't need fib lines. You don't need VWAPs or any of that. You just look to the left and see where there's some congestion or swings, and you're going to see where traders have acted, and they're going to act there again. Now, we have to put that in the context of a trend, support, resistance, and then look at the patterns that form. Now, multiple time frames. We have to choose the time frames. Are you a swing trader? Are you a day trader? You can be both. We can do both, but we can't mix the two together from the point of view of the biases. There are some gray areas, I'll give you that. But if I'm doing a swing trade and I'm looking at a weekly, daily time frame, I'm not going down to the 5-minute chart. I've done that, been there, given up good trades because of a red bar on a 5-minute chart or some retracement when there was absolutely nothing wrong with the daily chart or weekly chart, of course. So as an intraday trader, I'm going to use the 65-minute chart for my prevailing macro trend. And I'm going to enter on the 5-minute chart primarily. During times of really strong momentum, I'll go down to a 2-minute chart, but that's it. I'm not going below that. So what is the trend? Is it an uptrend? Is it a downtrend? How do we determine the trend? Really darn simple. Is it making higher highs and higher lows? Is it making lower highs and lower lows? Minor support. If it's in an uptrend, if it pulls back to what was resistance, there are going to be buyers there. Minor support. If it pulls back to a prior swing low, major support is the low prior to a higher high. That's a deeper retracement, but there's going to be buyers there also. So as this says, deeper retracements to major support or resistance are potential counter trend opportunities. The strongest trends don't pull all the way back to that major support level. And let me just draw this out for you for a second, because they say pictures 1,000 words, right? Here's an uptrend. What was resistance becomes support. So that's the way it works. Down here was the swing low, the higher high, major support. Now, a lot of this is just common sense, everybody. If something is in an uptrend making higher highs and higher lows, and it comes all the way down here, I don't need some Fibonacci tool, trend line, anything. Common sense tells me that that trend weakened. Simple. Keep it simple, stupid, as it says, right? All right. Let me erase that and continue. So, candlesticks. We're going to look at candlesticks. I got another slide there. This is primarily what we're interested in: wide bars or narrow bars. Psychology, right? Time frames, money management. And this gives you guidelines. You gotta plan the trade. What's your risk? We all deal with this fear of missing out. That's where the discipline comes in. It's not my trade setup, so I'm not getting in. It's moved. Sometimes you're going to miss trades. Revenge trading, that's a nasty one. It's like, oh, I'm going to get my money back. You get stopped out at the bottom, and so you start doing things that aren't a part of your trading plan. So again, you need a checklist as to how you're going to trade and when you're going to trade, and that is what keeps you in the game. All right, let me erase that. All right, so points here. As I said, looking at a 5-minute chart is not going to be your advantage if you're a swing trader or you're investing. Don't do it. Take my word for it. You'll if you're in front of your screen during the trading day, you may be looking at that, but as a swing trade, just set your alert to where you know prices shouldn't go and let it move around. Right? If you're day trading, what the hell are you going to be looking at a monthly time frame for? It's of little to no use whatsoever. So we want to keep things in perspective when we're utilizing multiple time frames. So this is the big picture of what we're doing and looking at multiple time frames. I already said for swing trading, we're going to be using the weekly and daily time frame. At times during strong momentum, I will consider, even for management, to look at a 65-minute time frame, but don't go down here, right, for your swing trades. For day trading, right, 65-minute, 5-minute, and as I said, 2-minute where there's strong momentum. In addition, at times, why would I use a 2-minute chart? Well, those times where you're waiting for your setup and you've determined based on the structure of the setup, let's just say there's some kind of a bottoming process going on here and there's a breakout. I'm doing little drawings here. There's a breakout. Right? And so now you're thinking, I'll buy the pullback. And you know what? The next one does this. And you're still thinking buying the pullback. Well, maybe it pulls back, maybe it doesn't. But two bars in a row is pretty powerful. So as we look inside of, let's just say this is our higher time frame. This is our higher time frame. Smaller time frames. I'm talking about, this and intraday trading. And I go down to a 2-minute chart. I'm going to see some of this, right? And this is the idea behind the dark blue line. So I'm explaining the concept of utilizing multiple time frames at the appropriate time. So smaller time frames mean that I expanded the data, and a higher time frame means I compressed the data. So if I look at a daily time frame and I expand the data into a lower time frame, I'm going to see more of this ebb and flow. Now I can't look at too many of these. It's going to lead to analysis paralysis, too much confusion. So I always like to say that this is not proprietary. There's no perfect time frame. Just look at this from the point of view that you are creating a method and a world that you're going to operate in, and accept that there is no perfect time frame. It's just not out there. But all time frames are displaying the same data. It's just whether you're going to break it up or you're going to compress it. And compressing it, there's less noise. Expanding it creates more noise. And so as things maybe become too noisy, like maybe right now in the markets, from an intraday point of view, I would want to look maybe more as a 15-minute chart to compress the data to eliminate some of the noise to get a clearer picture. Candlesticks. Let's just simplify this, boil it down. Take your candlestick book and just put it on a shelf somewhere and forget about it. All right? If you read it, good for you. I read it years ago. You know what? It helped in some ways. Here's the bottom line, everybody. Are they big candles? Are they little candles? Are there tails on them? Are there bars, big bars with tails, or are they little bars with tails? Is the tail on the top? Is the tail on the bottom? And everybody always thinks, well, how big of a bar is big, Greg? What's a wide range bar? You just look at it. When you're looking at your chart, you're just saying, man, that bar is big compared to the ones that preceded it. And so as you look at one stock, ABC versus XLY, different ranges, so on and so forth, but visually you'll see that they're narrow or big. So as we look at narrow ranges, it communicates that there's more of a equilibrium between supply and demand, or indecision. They're overlapping bars, top tails, bottoming tails, very similar to what was happening in the broader markets until we got this recent drop. Just lots of overlapping bars, breakout failures, breakdown failures, just a giant mess of uncertainty. But when you've got this type of narrowing range, let's say that this is in a downtrend and we get one of these big nasty red bars, that signals it's going to go lower. Or it's in an uptrend and we get a big green bar and put it over here, that signals it's going to go up. It's just common sense. Well, what if it's in a downtrend and you're looking at this and say it's in a daily time frame, and at 1 o'clock you're looking at this. You're going to be thinking, boy, that's turning around, it's going to go up. Now, this is a lesson you'll all learn, right? You either have or you will soon enough. The bar isn't done until you get to the end of the time period, because big green bars can turn into big topping tail bars, and that's a powerful pattern in of itself. In an uptrend, we want to see where buyers take control because it dipped down, it was weak, and it came back up again. All of this is common sense. You just have to get your head to think this way. Uptrends, buyers are in control. Downtrends, sellers are in control. Where does all of this happen? The location is the key point. Combining trend analysis with the price analysis, support and resistance, is what's going to put the odds in your favor as we continue to watch. Is momentum increasing? Is it slowing, or is it reversing? Right? So we don't need to know names. Right? And these are telling us how traders have acted. Now, as I look at these candles, I'm just showing you on this slide various bullish setups. And so the one on the top left was going sideways, and you can see it gapped lower and it went up, and it's a wide bar compared to these. That's bullish. Simple pullback pattern. And this was a red bar before it was a bottoming tail bar. It was down here, and it tells me that buyers showed up and took control, and now it consolidated. This on a different day could be this, right? Or a different time frame. This could be a higher time frame. This is a lower time frame. Our goal is to combine these together, which I'm going to get to. And so this went from red to green, and if they're wide bars, great. And if it's an uptrend, greater. Little continuation pattern. Just because you get a wide bar, it doesn't mean it's got to go straight up, but applying what I call bar by bar analysis will communicate to us what is happening. Consolidation, it was a red bar, turned into a bottoming tail bar. Traders bought the dip. It's in an uptrend. Odds are it's going to go up. Red bar ignored. That's what I call this, a red bar ignored. Sometimes you get red bars within an uptrend, and that reversed back up again. It's what should happen when demand is strong. This is what we call a 1, 2, 3 continuation pattern. A lot of times after a wide bar, you get a resting day, and then it continues higher. Happens the majority of the time. Right. I said, what do they all suggest? They suggest that buyers are in control. Odds are it's going to go up from there. All of these have produced a signal to now get long. The top left, buy it above the high, put a stop below the low. The middle top, buy it above the high, put a stop below the bottoming tail bar. The 180 reversal, same story. Buy above the high, stop below the lows, and so on. Continuation pattern. Buy it above the high. Wash, repeat. Right? Wash, repeat. Doing this for decades, this is what we do. And you know what? You find something that works, and you just continue to do it. Our struggle, in a sense, is finding these setups. That's what we use scans for, which are great. And I've created lots of scans for these. And So that this puts us in the ballpark of what we're looking for. Now we want to trade with the trend. At times we do counter trend trades, but we want them to be extended. For example, today in the chat room, I suggested, you can take a look at it, shorting Johnson & Johnson under yesterday's low. It got extended. I wrote a chart of the week on it. You can go to the website and check out chart of the week a couple of weeks ago on Johnson & Johnson. And I explained how it got extended and why I was looking for it to turn. It didn't turn right away. Nonetheless, now it's turned. So some traders are doing credit spreads. Some traders are looking for it to short, but look at Johnson & Johnson. So trading with the trend, as it says, puts the odds in your favor. Momentum works in your favor. Trade management is easier. There's going to be buyers on pullbacks. There's going to be those entry points, obvious stop loss places, cleaner chart patterns, less emotional stress. Yes, for sure. But if you don't utilize proper money management, you're going to be stressed no matter what you do. Right? So again, money management is a big thing. Right? So you're going to trade consistently. That's where you get your confidence from. And you ride the wave. Right? Multiple time frames in alignment. And think about it like this in addition, that you've got multiple traders working together for the same cause. And what that means is when multiple time frames are in alignment, you have traders on the daily time frame and on the weekly time frame and possibly even the monthly time frame that are all thinking either higher or lower. And they're all thinking how to participate to take advantage of those trends, how to get on board. So whether they're buying pullbacks or buying breakouts or continuation patterns, as technical traders, we're looking for pictures in alignment with our trends. So what I'm showing you here, it says smart moving averages. It's a way of looking at moving averages through the lens of multiple time frames. And I give you some calculations here as I put on the charts. So as it says, a weekly 10 MA is equal to the 50 MA. You got 5 daily bars times 10 gives you a 50 MA. So by looking at that 50, it's the green line on there. If it's rising, the weekly trend is up. I don't have to go look at the weekly time frame. You can, but I know the 20 is rising, and the 50 is rising. The 20 is above the 50, and they're both above the 200. That's the red line. And so the odds are it's going to keep going up until it stops going up, some failure. So the odds are in our favor. Moving averages, being visual aids, they allow us to look at one time frame and come to a conclusion in that without looking at lots of different time frames. I do the same thing intraday. 65-minute chart, 260 on the 5-minute, 13 times 20. And there's the 60 MA, that's the purplish line on my 5-minute chart right there. 60 MA. You may think, oh, is that something special with 60? No, it's just equal to the 20 on the 15-minute. That's all. If you wanted to put a 50 on there, it's going to be about in the same place. It's just, I know that this is where the 20 MA is on my 15-minute chart. So if they are all in alignment, this tells me that the 5-minute traders and the 15-minute traders, and in this case, the 65-minute traders, are all thinking that this stock is going to go up. So they're buying pullbacks and they're buying breakouts. The blue line is the opening price and the red line is yesterday's close. So all my 5-minute charts, they look like that. So when I look at the 5-minute, I can tell whether the candle, the daily candle, is green, meaning is it trading above the open, and is it trading above yesterday's close? And I set up my watch list in the same way. So I've got one column that shows change from yesterday's close and one change from day's open. And if it's 2 green columns, that means that's buyers are in control that day, just based on those columns and vice versa. But on my 5-minute chart, multiple time frame alignment, price pattern's in alignment with that, odds are it's going to go up. That's all we're looking to do here, is put the odds in our favor. And we know for a fact that if multiple time frames are aligned in the same direction, odds are it's going to continue to go up to the next resistance area. So all traders are working together. That is what we're focused on. That puts the odds in our favor. It's not about a MACD crossover, and it's not a MACD combined with a stochastics, with an RSI, and all of that stuff. It's about looking at what others are doing and what are their beliefs. How do we know their beliefs? Because if it's going up in multiple time frames, the majority believe it's going to go up unless it goes through the roof like oil did a couple of days ago, where it went up so far, so fast that it just was no air up there, so to speak, and it collapsed back down again. That's a climactic type of a pattern. Few examples. As I said, just keep washing, repeating. Weekly time frame is up. It's a 20 MA on the weekly time frame. If you did the calculation, it's equal to the 100 MA on the daily time frame. So I don't have to put a 100 MA. Sometimes you'll see traders with like 8 different moving averages, giant spaghetti screen on their daily time frame. You don't want to create a mess. You want to be able to see the bars, right? It's like you put an Ichikumi cloud on there. What a mess of that is, with all the colors and clouds and lines. Simplicity. Is it in an uptrend on multiple time frames? Buy pullbacks, buy breakouts. You have your bias. Look for a picture in alignment with the bias. Intraday trader, 65-minute is up. Look for the 5-minute to be in alignment with that. The odds are in your favor. 2-bar reversal down here. And this was a I'm just thinking to myself, some of the lessons that I learned over the years some things that used to shake me up until I understood completely this idea of multiple time frame alignment. I'd see a red bar like that on a higher time frame, and I'd be like, oh my God, that's going to go down. And I'd see it reverse back up again. I'd be like, how the hell did that happen? And I'd see the setup on the smaller time frame, and I wouldn't take the setup on the smaller time frame because there was a red bar on the higher time frame. And the realization was red bars turn into green bars. They turn into bottoming tail bars. They transition from red to green on smaller time frames. So on a certain level, you discount the red bars when multiple time frame alignment is up, and you wait for your smaller time frame to align and turn around. So you're not buying the bottom of the move, right? You could do that with the proper money management, but this is where the greatest odds are, right? Where everything is aligned in the smaller time frame. But what you could do down here, especially for 0 DTE credit spreads, is when you have this bias, a multiple time frame alignment bias, and you start to get a turn, 0 TTE credit spreads. Different stocks now have it 3 times a week. SPX, SPY, QQQ, have them every day. So that's a great strategy for one of the strategies that we utilize. All right. So a few examples of putting this together. So in the top left there is a 65-minute chart. And what that arrow is showing you is that inflection point there as it pulls back. So one of the concepts is a gap fill. Prices gap up, and as prices pull back into the gap fill in an uptrend, there's going to be buyers there. And let's just call it, Pavlov ringing the bell to the dogs. It's time to eat. They begin salivating. Traders are waiting down there. Now, this was the end of the day when it happened. But that's the thought process. It's in an uptrend. It comes down to a reference point where buyers are going to show up. You start looking in your smaller time frame for them to show up. Again, that was the end of the day. You could see it was 4 o'clock. There's going to be nothing to do, right? But if this was happening at 2 o'clock, I definitely got something to do. Now, the next day it gaps up. There's gap trades every day. It gaps up. Now, it may pull back into the gap fill, right? Wash, repeat. And that's what I'm thinking. I see a gap up. This is in an uptrend. I'm not shorting it, but I'm thinking I'm going to be a buyer down here when it fills the gap somewhere over here. I'm looking for this pattern down here. What happens though, and you need this bar by bar analysis concept of being able to shift your thoughts. So I'm thinking it's coming down here. Why? Because this green bar turning red bar back down and then a topping tail bar. It trades under here. Of course it's going to come down here and fill the gap, and there's going to be buyers, and I'm going to ride it back up again. And the market says, oh yeah, Greg, watch this. And it took out those lows and it goes right back up again. This is in alignment with multiple time frame alignment. So now I have to shift. And as a day trader, I have to shift relatively quick. This takes practice. And so now I'm a buyer above the highs. And I'm going to put my stop down here. I'm going to share size it accordingly, a little lower. And so from there, I'm going to looking to ride it up. My belief is that red bars like that should be ignored for the most part, minor pullbacks, and just continue for it to go higher. Higher to where? Well, see where there's resistance. But look what happens here. So as prices move up, and look at the time of day, right? It's lunchtime, and traders are going to lunch. Those that bought here, some are thinking, rightly so, why sell? Uptrend? I haven't even looked at a daily time frame, right? We haven't talked about that, but if we were, let's assume that this was just starting a move. It's got room to go higher. Look at how this begins to tighten up and go sideways for several hours. Look at the time of day, around 2 o'clock. This happens a lot, right at this time of day, right after 2 o'clock, where this 60-minute moving average, 60-period moving average catches up with the 20, right around 2:15. So you've got 15-minute traders, you've got 5-minute traders looking to continue to get on board on this trend, higher time frame trend. So they're all working together, looking for prices to move up. Now, forget about the prices here. It doesn't matter what stock it is. And we trade a lot of higher price stocks in the green room and in our swing letter. We just buy less shares, money management. But even if it was a $15 stock, it's all the same thing. It's all about pictures that we're looking at that represent what other traders are thinking. So, as I said, just continue to do the same thing over and over and over again. Right? Look for the same setups. 65-minute chart is in a downtrend. That's right, nobody's asked any questions, but you might say, well, why not a 60-minute chart, Greg? Well, because the 65-minute chart breaks it up into equal size bars. 60-minute time frame, either depending on the platform, the first bar is going to be a half hour, or the last bar is going to be a half hour. There's no magic to it. It just breaks it up into equal time period. So this started with a gap down. What is the thought? This is in a downtrend, short in the gap fill, where there's going to be sellers. Sometimes more aggressively, because short under the 5-minute bar is low. And I cover that in my gap course, when to do that. And you're going to share size it accordingly with the appropriate stop. So our focus here right now is to continuing this thought process of multiple time frames. These dots, everybody has them. As I said, nothing proprietary. You just tell your platform to put these swing highs or pivots, Some platforms call them fractals, and just set it to 3. And it just marks a bar with 3 lower highs to the left and right, or a bar with 3 higher lows to the left and right. And this creates little resistance and support areas. So as we continue this thought process, it's going to go up and fill the gap. Maybe that would be a high probability setup. And if it forms a pivot, and then it forms another one, and then it forms another one. And look at that bar right there, topping tail bar. It goes up. That tells me that there's sellers. They continue to show up there, but they're also buying the lows, and it's going sideways. They're not so sure what to do. They're kind of confused still. There's a battle going on. That's what traders are thinking. But the trend is down. The trend is down. The trend is down. I'm not going long when all these trends are pointing down. Now, look at the time. The 15-minute traders and the 5-minute traders are coming together. And this spring is coiling. It's getting ready to snap. Traders that are going long, that thought it would go up, are getting tired. This is what happens sometimes. And I'll say, I've said this many times, especially, in some of these webinars or in the green room, trading room, I'll say, what, sometimes prices go down because they didn't go up. And what that communicates is the trading psychology. And traders were apprehensive to keep selling, and some were buying for whatever reason. But eventually they get tired of trying to think it's going to go up and get filled here. And it often happens in the latter part of the day where they give up and throw in the towel when it begins to drop. And we're just continually watching for what traders are doing, bar by bar analysis, multiple time frames, and waiting for those high probability setups. Now, this is the current market environment. I captured this yesterday. I don't even remember what it was. I captured it yesterday because I wanted to show a great setup and what was not such a great setup for swing trade. So the market is volatile right now, and it's in a correction mode. So long swings at multiple time frames are fewer, but we have scans that find them. Right? It's just we find less of them. Whereas as things come together like here, there are times where we find so many we can't even do them all. We try and cherry pick the best. But I want to point out how to read the prices and why is this a great setup? Look at the moving averages down here. They're flat, pointing down a little bit. And then where it looks like it's going to go down, it explodes up with a wide range bar. Multiple bars moving up through all the moving averages. It slices through them like they're not there. Right? Moving averages are subjective, but it went through this resistance, that pivot. So now, what do you think? I'm thinking buy the pullback. That's what most are thinking. But as we look at this bar by bar analysis, what we see is that other traders, I don't know why, they're more aggressive than me. Meaning they're not looking to buy the pullback to the moving averages or this minor support. They're just buying it anyway. So I have to begin to shift my thinking. This is the power of bar by bar analysis. It forces you to recognize what's happening. So I see they bought the pullback, they bought the pullback. It's getting even tighter. Let me get in above these highs. You might say, but Greg, look what happened. This is why money management and knowing where to place your stops is so important. You don't have to go all in. You could put in a partial position and give it more room. So this is like in the past, oh my God, a red bar. It's going to go down. I'm going to get stopped out. Just hold on there. This could be noise. You might get stopped out. You're just going to have to wait and see what's going to happen because that's the way the markets are. Now, when this flips up like that, there's a sigh of relief, right? Every bar can create some tension because it's not what you want to happen after buying here. But it's going to happen. But now when I see this, I mean, like relief, for me, I got it locked. Now I'm adding, because now whoever the buyers were here that were buying here, right? Remember the bottoming tail bars, they're stepped up again. And not only did they step up a little bit like they did here, they did it aggressively. Look at the size of that bar. Buy more. Manage it accordingly. Like I said, over here, it's not a great setup, but it's at a moving average. It's at a rising 50-period moving average. Yes, but moving averages are subjective. It violated this support. It failed to go up here. It's not a great setup anymore. But 3 days going sideways, I might be a little interested in that for a day trade. This begins to build a base intraday. It might be able to get up here. I'd have to look at that intraday. I make a decision in the moment, but I just want to share this idea that 3 days going sideways on a daily chart creates a base intraday, and I like that for intraday trades when I combine the daily time frame. All right, here's a sell setup. And everything works in the other direction. This started with a gap, big down bar. It grinds up into resistance. I know where the sellers are. Theoretically, like most times, it's not going to get up there. Right? Because with a wide range bar like that, most times it doesn't. Sellers are going to be more aggressive. So we have different rules for trading this. But when it does get up here, I know there's going to be a lot of sellers. There's an unfilled gap. There's converging moving averages. Now I just need a candle that communicates to me that these longs that bought this breakout are caught. And down it goes, wash, repeat. All right. Moving average, not moving average, money management. This gives you guidelines for money management, keeps you in the game. Just theoretical account, break it up into 4 trades. In our tracking sheet, we use $300 for risk of every trade. It is tracked that we give in our letters. They're tracked in that tracking sheet that you get access to with the letter. So everything is transparent. The entry point, the stop, how it did, where the stop was, how much money it made or lost, and the share sizing is all calculated there in the tracking sheet. And so this gives you, daily, what's your bias, multiple time frames, everything we talked about. Risk management is key. Your trading plan. You're creating a belief system. How are you going to create your belief system? With indicators? I suggest you don't. Too many settings, too much confusion, multiple time frames, candlesticks, everything we talked about. Price is the consistent, right? We only change the time frames to the ones that we want to use, and our edge is the trend. From there, apply what I've shown you. Now, there are attributes to how things pull back and go up, and the trends and so on. And of course, that's what courses are about. I can't cover everything in 40, 50 minutes here, but I've covered a lot with you. And so the courses get deeper into money management and all of that. And so what I offer today is just that. And it's an amazing offer. And you have to be willing to make an investment in your future. And these courses will deliver. Swing trading course, a gap trading course that trades you how to trade gaps in the morning, as well as how to use those gaps in the latter part of the day. For swing trades, if you choose to use them or carry them into the next day. I included an options course for MTS, insight into using options. 3 months of the advisory letter. So 3 months, all of our trades. I do an extensive weekly update on the broader markets and sectors. And of course the trades, coaching, and I will send you my last coaching session, and the scans that I've created in TC2000 are included. If you use the platform, I'll share them with you at no extra cost. And this is a no-brainer offer there to getting those courses with lifetime access. So mastertrader.com/MTF. If you have questions, email me, Greg@MasterTrader. Happy to answer whether you take the offer or not. Always here to help traders.